Hello everybody. Today we're going to be talking about all things that has to do with ETFs and equity mutual funds. So this is like a clash of the funds. Which one is better for your portfolio as a beginning investor? My name is Daisy and this is Growing Wealthy with Daisy, where I take you through my wealth journey with the hope that it will inspire you and prevent you from making the mistakes that I have made, because I made a lot of mistakes in my investment journey. So if you haven't subscribed yet, click that button, subscribe, like, share, and let us begin our wealth journey. What is an ETF? An ETF is an exchange traded fund. It's a fund where you buy units and those units are used to acquire shares on the NGX. An equity mutual fund is also a vehicle where you buy units and those units are used to acquire shares on the NGX. So what is the difference? The difference is you can actually buy and sell the ETF on the secondary market like any other stock or share, but you cannot buy and sell a mutual fund on the NGX, on the equity market. So that is the basic difference between an ETF and an equity fund. And I have come to realize that ETFs are more expensive when it comes to management and fees and all of that. But that's a long story. Why am I doing ETFs versus equity funds right now? Well, I'll tell you a story. This one happened very recently. I enjoy experimenting with the various vehicles that I can use to grow wealth. Remember, our wealth growing vehicle is equity, while our wealth preservation vehicles are bonds. Okay, so we do bonds, we do treasury, money market to preserve capital. But when we want to grow capital, we use equity. I am kind of adverse to buying single stocks because the money never languish like that. So I prefer to invest in equities via the equity fund. But during that incredible rally of the stock exchange, while my equity fund was doing 51% per annum, or rather year to date in 5 months, one equity stock, one ETF was tearing 120%. So of course I got interested now. 120% in 5 months. Who would not be interested in that? So you know your girl. I quickly, there's some money that came in, and instead of rolling that money over to my equity fund, I decided, okay, let me use this one to buy ETF. After all of them are equity. It's still part of my equity investment. So I bought the ETF. 2 months down the line, this ETF is not performing. I don't know if it was just hype. We know that the market, there's been a lot of cost correction in the market, and we know that people have been profit taking. So the market has not been stable. Okay. And some prices of stock have been falling. So I know all that. However, since this ETF is not doing me as I wanted it to do, I was like, let me just pull back the money, liquidate this investment, and put that money back into my equity mutual fund where I understand what is going on because I've been using it for more than a year. And so I listed it to be sold. Men and brethren, this is a week plus. It's not selling, like it's just there. It's just there. I can see the balance in my wallet, but it's not yet available for me to withdraw. So for like 1 week, that money has been tied down. It's not making a profit, it's not making a loss. I'm not comfortable with that kind of thing. So I had to look back. What are the inherent differences between an ETF and a mutual fund? And if I can share this with you, maybe most of you will not make the mistakes that I made with ETF and mutual fund. Am I saying ETFs are bad? No. But I'm saying that when it comes to liquidity, I have found out, I could have read it in a book, but I have found out through experience that at times, most times, your equity mutual fund is way more liquid than your ETF. Why? Well, first and foremost, you sell your ETFs on the stock exchange, unlike your equity fund, which you just tell your managers, okay, I not do again, I want to redeem my funds. And under 24 hours, your funds are in your account and you can do whatever you want with it. This one is 1 week ETF. So who buys when you are liquidating? The ETF is normally bought by another investor or the market maker, which is your platform, buys it back from you. But the equity fund, the fund itself buys your units from you. So it's the fund manager that liquidates your units for you. When it comes to price, how do we sell ETFs? ETFs are sold by market price. So there's some, it's like a stock now. So the prices go up and prices go down. So when the prices go down, which is why I was selling, because the prices kept on going down, it did not go up in 2 months. So of course I decided to sell. I don't want to be throwing away money now. I'm putting 100,000 naira, and I open my app, I'm seeing 91,000, 90,000. I don't do now. So I tried to sell, cut my losses. 10,000 naira is enough now. I'm just saying. And so it sold at market price. So of course I sold at a loss. But your equity mutual fund is usually calculated. They have this thing they call NAV and your value. So the value is calculated for that day. Remember, equity funds, they calculate their value once in a day at the end of the business day. So that is how you get the value for your equity. Liquidity, which is the cocoa of this video. Liquidity of an ETF is based on trading volume. It's based on people who are willing to buy, or if your market makers are willing to absorb that unit at that moment. That is the only way you can liquidate your ETF. But equity funds, on the other hand, the fund normally has a redemption process. And the minute you put in your request, it goes through their process and they liquidate it for you. So it's the fund managers that do the liquidation, and most times it is instantaneous. I have never had to wait for more than 24 hours to access funds from my equity um, mutual fund, right? Equity mutual fund from my money market mutual fund. I've never spent 24 hours. It comes out same day. But the ETF now, you see what it's doing to me 1 week plus, the money has not still been released. It's a problem. So when we talk about bid ask spread, that is the spread between buyers and sellers, there is actually a large spread in the ETF. Remember, it is like a stock. So there must be people who are willing to buy before you're able to sell. Unlike your equity mutual fund, where there is no quoted spread. So what you see is what you get. When they do their calculation at the end of the day, they liquidate it and they give you based on what the value is at the close of business of that day. Execution. How quickly is the trade executed? ETFs can be immediate if there are buyers. But like I have seen in my situation, it's not immediate. This is like 1 week now. So yes, I think it depends on how many buyers are willing to buy that ETF at that point in time. But when it comes to execution of your funds for the equity mutual funds, it is subject to the fund's redemption cycle. So if, like for example, when you buy an equity fund, right? Sometimes they tell you cannot liquidate for the first 30 days, you can't liquidate for the first 90 days. But after that, it's near instantaneous. So yes, it's near instantaneous. It depends on the fund. And that is where you have it. So why does it matter? When in this your wealth journey, should you choose an ETF or should you choose an equity fund, given that they both do the same thing, but they are completely different vehicles? Well, I will give you my own experience. So after this experience with this ETF, it will be hard for me to actually invest in equities through an ETF again because liquidity is very important. Speed, liquidity, it is very important. And the ETF has shown me through this process. Perhaps there are other ones that sell rapidly. I don't know, but this is the best selling ETF in Nigeria. And if within a week I cannot liquidate, like the money has not dropped into my account, well, yet it's a problem, right? Because that money, I had plans for it and I can't execute those plans, so liquidity is a problem. But the equity mutual fund has never given me that issue. It is as liquid as I want it to be, and that is an advantage. So if you're just investing in equities and you decide to use a fund instead of buying individual shares, which is what I would suggest, given the fact that you are a beginning investor, you're a young investor, you're just learning your ropes, you're investing through a fund, I would prefer, or rather, in my own opinion, I think I prefer an equity mutual fund over an ETF simply because of liquidity. I don't really care how much the ETFs are making. They can make 200% for all. I don't care. I don't care. I will stick with my equity and watch it grow gradually and have peace of mind knowing that I can do same day execution and my money drops in my account. So that being said, what are the things that you look for when you're evaluating an ETF? I'm going to make a whole nother video on that, but let me just run through some of the things that I think that we should look at. The average daily trading volume. If I had paid attention to this, perhaps I would not have been in the situation that I am in. But now I know what to look for. I also know that I'm supposed to look at the bid-ask spread. I know I'm supposed to look at the number of trading days, the presence and the activities of market makers, and the assets under management, and so on and so forth. I'm going to do a full video on that. And of course, since you're subscribed to this channel, if you are subscribed to this channel, then you get a notification once that video drops. So here we are. Diversification solves one problem, liquidity solves another. As much as I love being diversified, I prefer to be liquid when it comes to my equity. So for the win is the equity mutual fund. And that is where we draw the curtain for today. I'm going to do a complete video on everything you need to evaluate in an ETF before you buy. I'm also going to do a complete video on everything you need to evaluate on an equity mutual fund before you invest. So like, share, subscribe, and I'll see you in the next video.